In a world where banks make billions off your confusion, your debt, and your mistakes, one man built a fortune by doing the exact opposite. No hype, no shortcuts, no noise, just 5 simple rules. Rules so simple, most people ignore them. Yet those same rules turned him into one of the richest men alive. And here's the uncomfortable truth. These are the exact rules. Banks hope you never understand, because if you did, you wouldn't need them the same way. Context, setup. Most people think investing is complicated. Charts, predictions, endless financial jargon. They believe success in the market requires brilliance. But Warren Buffett didn't win because he was the smartest person in the room. He won because he was the most disciplined. He didn't chase every opportunity. He ignored most of them. He didn't try to move fast. He moved with patience most people don't have. He wasn't playing the game better. He was playing a completely different game. And the first rule of that game is where most people fail. Rule 1, never lose money. Never lose money. It sounds obvious, almost too simple, but in reality, it's incredibly difficult because the market doesn't just reward intelligence, it punishes emotional decisions. In 2008, the global financial system collapsed, major banks failed, markets crashed, millions of people lost everything, fear took over, people sold at any price just to escape. But Buffett didn't panic, not because there was no danger, but because he understood it. He knew the difference between price and value. He knew that in moments of fear, markets become irrational. So while everyone was running away, he was buying. He invested billions into strong companies whose prices had temporarily collapsed. This wasn't luck, it was discipline. Because to Buffett, losing money doesn't happen when prices fall, it happens when you make bad decisions, when you sell out of fear or buy without understanding. Most people don't lose because the market is against them. They lose because they are against themselves. But this rule alone isn't enough, because it only works if you follow rule number 2. Rule 2, invest in what you understand. Buffett has a simple principle. If I don't understand it, I don't invest in it. He calls it his circle of competence. Think about it. If you invest in a business, but you don't understand how it makes money, you're not investing, you're gambling. In the late 1990s, the world entered the dot-com boom. Technology stocks were exploding. Any company with .com in its name was skyrocketing. People were getting rich overnight. The pressure was everywhere. You're missing out. Everyone is making money. But Buffett stayed out, not because he didn't want profit, but because he didn't understand the space. He said something most people are too proud to admit. I don't understand this. People laughed at him. They said he was outdated, that he had lost his edge. Then the bubble burst. Trillions of dollars disappeared. Companies collapsed. Dreams vanished. And those same people were the first to lose everything. Buffett, he was untouched because he never entered the game. That's the lesson. Not everything that looks like an opportunity is won. And sometimes the most powerful financial decision you can make is to say no. But understanding alone isn't enough, because you can understand something and still choose poorly. That's where rule number 3 comes in.
Rule 3. Buy great companies at a fair price. Most investors look for cheap, undervalued stocks, hidden opportunities, bargains. Buffett looks for something else: quality. In 1988, he made one of his most famous investments. He bought Coca-Cola. It wasn't extremely cheap, it wasn't a secret, but it was powerful. A global brand, a product consumed daily, deep customer loyalty. Buffett didn't just see the price, he saw the future. He saw that 10, 20, even 30 years later, people would still be drinking Coca-Cola. That was enough. While others chased what might go up, he focused on what would last. And that's a critical difference. Because a bad company, even at a low price, is still a bad company, but a great company, even at a fair price, can create massive returns over time. And this is exactly where banks win. They want you moving, buying, selling, switching. Every action you take generates profit for them. Fees, commissions, spreads. Buffett doesn't play that game. He buys and he holds. But holding requires patience. And that leads to rule number 4. Rule 4, think long term. We live in a world of speed, instant results, quick rewards, constant updates, but investing doesn't work that way. Buffett doesn't think in months or even years. He thinks in decades. He once said, "Our favorite holding period is forever." Why? Because the most powerful force in finance is time. Not timing the market, but staying in it. Compounding is what builds real wealth. When your investments grow, they start generating returns. Then those returns generate more returns. And over time, that growth becomes exponential. But there's a catch. It requires patience. And patience is rare. Most people want results now. They want confirmation now. They want profit now. So they buy and sell constantly. And every time they do, they lose a small percentage. Fees, mistakes, emotional decisions. Over time, that small loss becomes a massive gain. But not for them, for the banks. Buffett doesn't move often, but when he does, he's confident, and then he waits. But even if you're patient, even if you understand, even if you choose well, there's one thing that can destroy everything. And that's rule number 5. Rule 5, control your emotions. The market isn't always logical, but it is always emotional. Fear and greed. These two forces destroy more wealth than any crash ever could. In 2020, when the pandemic began, markets collapsed rapidly. People believed the worst. They sold in panic. Fear took over, but soon after, markets recovered. And those who sold at the bottom locked in their losses. Those who stayed recovered and grew. The difference wasn't knowledge, it was emotional control. Buffett doesn't try to eliminate emotion. He refuses to let it control his decisions. He expects volatility. He expects fear. He expects uncertainty, but he doesn't react to it. That's the edge. Not being right all the time, but not destroying yourself when you're wrong. Banks rely on your emotions. Fear makes you sell. Greed makes you chase. Either way, you move, and they profit. But if you stop, think, and stick to a strategy, the game changes. Conclusion, actionable takeaway. 5 rules, not secret, not complex, not new, but powerful, because they require discipline. Never lose money. Invest in what you understand. Buy quality. Think long term. Control your emotions. This isn't just a strategy, it's a mindset. The difference between success and failure isn't knowledge, it's execution. Everyone hears these rules. Very few follow them. So the real question isn't, do they work? The real question is, will you actually follow them? Today, call to action. If you want real strategies, not hype, subscribe now, because the next video won't just teach you about money, it will change how you think about it forever.